Welcome back to Kitco News. I'm Jeremy Szafron. Well, right now, Washington and Moscow are in a high-stakes meeting, and at the time that we're taping this, there's no deal, but the money markets and the power at stake are enormous. Now, the U.S. has $300 billion in frozen Russian reserves on the table. BRICS nations, of course, are accelerating plans to trade in gold and local currencies, and the dollar's role at the center of global commerce is facing its most serious test in decades. And if these shifts, even one of these levers, start to shift here, sanctions relief, maybe oil, supply routes, or how countries store their wealth, the ripple effects will hit currencies, commodities, and capital flows worldwide. Steve Hanke has been in these kinds of battles before, advising governments in crisis, running the world's best-performing emerging market mutual fund back in 1995, and of course, tracking monetary trends that others miss. He's professor of applied economics at Johns Hopkins University. He's a distinguished senior scholar at the Mises Institute, and he's also the author of Making Money Work, that book being released back in May. Steve, great to see you. Appreciate you making the time today.
Well, Jeremy, great to see you.
I want to start here. We're under an interesting macro lens here. I mean, we have this meeting happening in Alaska with Trump and Putin. And let's start there. What's your immediate read on this meeting?
Okay, let's set the table on this, Jeremy. I think the best way to do it is to let's talk a little bit about the personalities that are going to be there first. Mm-hmm. We've got on the one side Vladimir Putin, who's actually a very experienced and sophisticated diplomat, and his foreign minister, Lavrov, is probably the world's premier foreign minister, and the whole phalanx of professional Russians will be there. On the U.S. side, we've got President Trump, who's really a reality TV guy more than anything else, and quite effective at that, by the way. Mm-hmm. But he's not into the weeds and depth and so forth in terms of foreign policy and what the issues are and everything. So he and Putin are kind of literally on the opposite ends of the spectrum in terms of knowledge and experience and so forth. And then you've got the rest of the U.S. staff is, not up to the professional level of even close to the Russians. So that's kind of an asymmetric thing. And then getting down into more concrete things, the war is going on. That's what they're going to be talking about, ending the war. But the war has already been won by the Russians. So what you have is that Putin basically has all the cards, and he has a known list of non-negotiable demands that he will not change on. He will not budge on. And so there you have it. So why are they having a meeting? Well, I think the main thing is it's going to be a great photo op for Trump and a complete victory for Putin, because Putin, was a pariah. No one would talk to him. No one would let him on their soil even. He's going to be on the United States of America's soil, some soil that the Russians happened to have sold the United States some years ago when McKinley was the president, if anyone can remember that far back. So there's my take, and nothing is really going to happen except the photo op. And there'll be, some rhetorical flourishes and so forth, and we'll have to move on from there. Yeah. I think, by the way, that as far as the war is concerned, Russia has won, but to actually come to a ceasefire, that's one thing. But a real peace would it require all these non-negotiable Russian positions to be met and demands to be met. So that the peace might be a long way off. It might never occur. We might actually have a ceasefire and a kind of frozen war for, if you will, for a long time.
Yeah. I mean, to your point, it's nearly 20 years since the U.S. has hosted a summit on U.S. soil with Russia. What is to lose here for the U.S., or for Russia, rather? I mean, something got Putin there besides just maybe the photo op, or is it the photo op, or is it the treasuries, that are being held under sanctions? Is it an economic threat? What are your thoughts?
They can threaten Russia all they want, and I think it's pretty much irrelevant. When I said non-negotiable, the key thing is non-negotiable, and one thing that's non-negotiable is that Ukraine will end up after the war, if there actually is a peace, it will have to be one in which the Ukraine is neutral, somewhat like Austria was after World War II, something like that. In other words, they won't be a member of NATO. There won't be Western Europe or U.S. troops in Ukraine. None of that kind of stuff.
Yeah.
That's a no-go for Russia.
Yeah.
It's a spoiler. So there's this thing will drag off for a long time because of these non-negotiable demands. And why did the war start? Well, the war started because the West went over red lines, that Putin had made very clear what the red lines were and what the non-negotiable aspects of things happened to be. And the West just basically ignored it and went over the red lines, and Russia made its move.
Yeah. And to your point, I mean, it's been an interesting time since then on the dollar front. Back, of course, in 2022, the U.S. and its allies froze that $300 billion roughly in Russian reserves. I'm curious, I mean, for a central bank governor in Asia or the Middle East, is the greater long-term risk the president that reserves can be seized, or maybe the speed at which alternative systems are now being built?
Well, I think everybody, what we're really talking about here, the weaponization of the U.S. dollar with sanctions, which I'm opposed, obviously, to all sanctions, being a classical liberal Austrian school economist, free market economist. So the freezing of the sanctions, it's literally theft. I mean, you're talking about the fundamental underpinning of any kind of capitalist society is what? It's property rights, the free of trade, and the liberty to people to engage in trade and commerce. So that means, by definition, I'm against all sanctions in principle, and I'm against all tariffs, and I'm against all non-tariff barriers, and I'm against all quotas. So if any of those things come up on my radar, I'm automatically, in principle, my knee-jerk reaction is to be opposed. Right. Now, as a practical matter, let's move beyond the theory and the principles, and as a practical matter, let's talk about sanctions, because and freezing of assets. That's what you're getting into, these reserves, for example. Now, it turns out that there's a great scholarly literature on sanctions. There's a lot of material that's been written. And the conclusion is that there's very rare cases where they actually have worked to achieve the stated objective that the sanctions have. And the two aspects of that. One, once you impose sanctions, there's usually a tremendous number of unintended consequences that you never anticipated, and there's a backfiring kind of effect. So let's take Russia. Russia is the most sanctioned country in the world by far. There's no one even close. Not even North Korea, not Venezuela, not Cuba, none of these other things. Those are peanuts. Russia is the one where you have the huge sanctions. And the blowback has been that who's paid for this? Well, the Europeans. The European economies are really in trouble, limping along. Germany is the most manufacturing-oriented economy in Europe. About 23% of the GDP in Germany is manufacturing. The average, most of the countries in Europe, it's about 12%. So Germany's manufacturing heavy, and manufacturing takes a lot of energy. It takes a lot of electricity, to make a long story short, and a lot of gas and fuel. And with the sanctions, what happened? Well, that's been cut. Russian fuel has been cut to a dribble going into Europe. And among other things, of course, it's pretty clear that the West blew up the Nord Stream pipeline. So that cut off Germany. So Germany is really in bad shape, really, really bad shape. But all of Europe is in the same bag, and they have all kinds of fiscal problems, slow growth problems, and they were welfare states, and now they add to that they become warfare states. They're trying to militarize themselves. So that's all money down a black hole, and certainly it doesn't add anything to productivity or prosperity. So that's the backfire effect of sanctions. Now, what about the recipient country where you're aiming the sanctions at? You get a rally around the flag effect. So it actually keeps the elites that you're after in power. Mm-hmm. Putin is more popular now than he was before the war started. Think about, for example, Castro and the revolution in Cuba. And it's been one sanction after another in Cuba, but the communists are still there. What about North Korea? We've had all kinds of sanctions on North Korea. We got the same family running the show, the communist show in North Korea that we had since the beginning. Look more closely at Venezuela, where I was Rafael Caldera's chief economic advisor in 1995 and 1996, and Maduro, who's a socialist / communist. He's been in power 11 years. He's destroyed the economy. They've had 2 hyperinflations in that 11-year period, and he's still in the saddle. Why? Because of the rally around the flag effect that the Venezuelans rally to, because they're being sanctioned by the U.S. and other Western countries. So that's my take on sanctions. And to paraphrase Daniel Patrick Moynihan, sanctions are for losers.
I mean, you were just talking there, Steve, about, obviously weaponizing the dollar and what's taken place with those sanctions. If you were advising one of those countries under a currency board today, I mean, what kind of concrete steps would you take to make their reserves untouchable without abandoning dollar liquidity entirely?
Well, one thing to do is something I've actually written up and published, I think, both in Forbes magazine and National Review, with actually the draft law and bylaws and so forth. I recommended that Turkey, which as you know has an endemic currency problem, Iran, which has an endemic currency problem, and also Russia, use a currency board arrangement and have the anchor as gold rather than a fiat currency issued by any country. So if gold, of course, is not a liability of any country. It's not issued by any country. It's neutral in that sense, and that's why it's attractive for a country like Turkey, which the Turks like gold. So the Iranians do too, and not so much the Russians, but they're certainly not averse to it. So how would this work? It would work like a regular currency board, only the anchor would be gold. So there'd be a local currency that was issued, and that currency would trade at a fixed exchange rate with gold, and there'd be a requirement that the local money issue had to be backed 100% with gold reserves. And that always makes the currency boards credible, because you can take the local notes and coins in and exchange them for gold, and the gold will be there. So you keep, obviously you'd keep the gold locally. You wouldn't be keeping it in London or New York.
Yeah. Yeah, oh man, I could get into so many things. We got to ask you a little bit about the repatriation of gold there. But before you do, since that the freeze that we just talked about, cross-border yuan transactions have more than doubled. I mean, India's dollar share of oil purchases is down 80% to under 40%. BRICS nations are testing this gold settlement platform and kind of bilateral currency deals. Are these serious structural threats to the dollar's dominance, or do you think that these are just more political theater that won't last right now?
Well, right now, again, you have to let's set the table and look at the historical context. If you look back 2,500 years, there's always one dominant currency and one international currency, and those currencies there have only been 14 of them in the last 2,500 years. So it's pretty hard to knock a dominant currency off the saddle or knock the king off the throne. You got King Dollar on the throne. It's going to be hard to challenge King Dollar, but it's possible. And look at pound sterling. Before World War One, sterling was on the throne. It was a king, and the dollar knocked it off because the monetary policies and fiscal situation and economic situation in England was a disaster after World War One. They got into a lot of debt, a lot of economic problems, and eventually the challenger, the U.S. dollar, knocked them off the saddle. So, what will make the U.S. dollar vulnerable? And the weaponization of the U.S. dollar and the use of sanctions makes it vulnerable, and we are seeing challenges out there. So I don't think right now they're at the margin, and of course, in everything in economics, everything happens at the margin, but they're kind of footnotes. Mm-hmm. Nothing really big time, but it exists. Yeah. And if we didn't have sanctions, the challengers would be out to lunch. There'd be no footnotes about challengers. Even no one would be even talking about it if we hadn't weaponized and if we hadn't frozen these Russian assets, for example, and done all kinds of basically illegal things. But who pays attention to international law? Who pays attention to international law these days? It's an ad hoc thing. I mean, if it suits the powers that be, they impose international law, and if it doesn't suit them, they just ignore it.
Oh, sorry, I just lost you there for a second, Stephen. But we were talking about sanctions, which obviously means erosion of trust in foreign-held reserves. I got to ask you about gold. We'll stay on that theme a little bit. I want to play a clip from U.S. Treasury Secretary Scott Bessent. He was on Fox Business earlier this week.
We've got the large gold holding. I doubt we're going to revalue it, but we are going to keep it there, again, as a store of value for the American people. We've also started to get into the 21st century, a Bitcoin strategic reserve. We're not going to be buying that, but we are going to use confiscated assets and continue to build that up. We're going to stop selling that.
Okay, so he says he doubts that the U.S. will revalue gold, but he didn't slam the door on the idea either. Steve, I mean, you've argued that a gold reevaluation is maybe unlikely, but when a Treasury Secretary even entertains the question, doesn't that kind of telegraph to global markets that the dollar's footing might not be as solid as Washington claims? What are your thoughts here?
Well, the Secretary, as usual, doesn't really make much sense. Think of what he's talking about there. He's talking about the gold reserves, backing up the U.S. dollar, and then all of a sudden he jumps into Bitcoin. Now, there couldn't be anything more different than gold and a Bitcoin, for God's sakes. I mean, Bitcoin it has no fundamental value, even though its price, by the way, has just reached an all-time high. It has no fundamental value whatsoever, and it's nothing more than a highly speculative asset. So why is he peddling that as being a great thing? He doesn't make any sense. If you listen to him, it's just one pretzel logic interview after another. He gave an interview with Larry Kudlow the other day on Fox, by the way, which he said actually a shocking thing. He said that we view, or he views the wealth of the Europeans as something that we have rights to in some way. That was talking about tariffs. And even Kudlow said, well, he said we can appropriate those. We can appropriate that wealth. He used the word appropriate. And Kudlow stopped and said, well, he said, I think you're talking about theft, aren't you? So there we have the Secretary of the U.S. Treasury talking out of all sides of his mouth, not making any sense with any kind of a coherent strategy or anything like that. I mean, it's just, jaw dropping. What can you say? Now, by the way, his latest stupidity, the secretary, he now is talking about monetary policy in Japan. A U.S. Secretary of Treasury complaining that they haven't increased interest rates enough in Japan to fight inflation. Well, it turns out it's a ridiculous statement. He doesn't know what he's talking about, never has understood the quantity theory of money. The rate of growth in the money supply is so low, it's de minimis, and has been for about 30 years in Japan, and that's the problem. It's slow growth. It's tight monetary policy. He wants to even tighten it up more with higher interest rates. I mean, the guy's never checked the money supply figures for Japan. Point number one, just as a factual thing, but as a matter of principle, I mean, U.S. Secretaries of Treasury don't interfere with foreign monetary policies, but the Trump administration seems to have the idea they have a license to interfere and meddle in any damn thing they want to, any place, not only in the United States but any place. I mean, you're up there in Vancouver today, Jeremy, and ask the Canadians what they think about the U.S. meddling in Canadian business.
Yeah. There's a lot of people talking about it up here, Steve. Back on that gold front, I know that you know economist Judy Shelton. She's obviously a vocal supporter of sound money. She's proposed a middle path, issuing these Treasury bond convertible into gold at maturity. I guess if you want to call them, these trust bonds would give investors kind of a tangible link to gold without fully reinstating that rigid gold standard. I guess the bigger question is, if global trust in the dollar is eroding, Steve, I mean, could a partial gold link actually restore confidence, or would it just expose Washington to even more constraints?
Well, I think I think Judy's proposal, which I've known quite a bit about because I used to go to Bob Mundel's Palazzo in Italy every summer for a round table, and Judy was, in fact, chairing it towards the end. So I'm very well aware of what she's proposing, and I see, quite frankly, nothing in principle wrong with it at all. I think in principle it's fine. As a practical thing, I'd want to see it worked out and see whether you really can market this stuff and whether it would be efficient and whether it would increase or decrease credibility in the dollar and so forth. There are a lot of issues, but I certainly would keep it on the table as an option. Now, the one thing, when you say the credibility of the dollar, we have to talk about the most important price in the world is the dollar euro exchange rate, and where is the dollar? It's lost a little value against the euro in the last 12 months or so, or maybe a year and a half, but it's trading at like 117 or something like that. It's extremely strong. I think the fair value of the dollar euro rate is between 120 and 140, and it's been the dollar's been less than 120 for like 4 years or something like that, maybe even longer. I can't remember exactly, but it's been extremely strong. So again, the narrative about the losing the trust in the dollar and so forth, I have to strain to swallow that.
Yeah.
I mean, it's just not the reality. There's a lot of shop talk about this, people talking about it all the time, and I do agree, as I indicated before, sanctions and weaponization of the dollar and the dollar financial system has made the dollar more vulnerable than would have been the case if they would have not imposed sanctions and weaponized it.
I wonder often, too, just about the folks at home that realize, what was $20 now feels like $5. I mean, that debasement, how much has that been a threat to the U.S. system, too?
I think it's essentially irrelevant.
Yeah.
People became very even think in terms of you have to look at balance sheets, and the balance sheets of people who have had positive net positions in their balance sheet have exploded even since COVID. Now people don't realize this. One thing that Matt Zakurki and I talk about in our book, Making Money Work, is that one goal of monetary policy should be neutrality, and now monetary policy, the way it's been executed, is non-neutral. It's created a huge amount of income redistribution and inequality in the United States. In January of 2020, the month before COVID hit, and the month before the Fed started putting its foot on the gas at the printing press, billionaires' wealth as a percent of GDP in the United States was 14.1%. Today, it's 21.7% of GDP. So the explosion in the money supply did what? It did what it always does. With a lag, asset prices go up. Real estate goes up. Land goes up. All commodities go up. And the stock market booms. That's what happens when you goose the money supply. And then the real economy starts revving up a little later. And then the last thing that happens is inflation hits. So the policy the Fed has been following is massively non-neutral, which, according to our work, is bad. They should be having a steady growth in the money supply, neutral, so individuals and particular sectors of the economy aren't benefiting relative to other sectors or portions of the population. So that back to your point about the erosion of the value of the dollar, it is true. If you had a dollar bill and you stuck it in your wallet 20 years ago, it wouldn't buy a hell of a lot today, that dollar that you had in your wallet. So in that sense, you're losing money, or losing purchasing power. But the point is, you have to look at your overall balance sheet. What's happened to the balance sheet? If you had a net positive position, your balance sheet's exploded. So the point is, one thing is the physical dollar itself, or liquid dollar deposits. The other thing is dollar-denominated assets. Dollar-denominated assets have exploded. Why do you think the capital flight comes into the United States? Everybody wants to be in dollar-denominated assets. So that's a side of the picture that the sky is falling. The types are always talking about the dollar, this, that, and the other thing. But you have to look at the overall picture.
Yeah.
If the dollar is so bad, why in the hell does everyone want to hold dollar-denominated assets? Why does everybody want to be in New York? Why are portfolios before the last tariff brouhaha with Trump? Everyone so overweighted in New York, it was unbelievable. Now there's been a slight adjustment and rebalancing of their portfolios and pulling a little out of the dollar-denominated assets, and that caused a little blip in the European stock markets, by the way, after Trump was elected. But you just got to put things in perspective a little bit. So I like to say, get real,
I like it. Well, that brings us, when we talk about the global money supply, obviously there's some inflation signals there. I want to get your outlook because obviously, you track broad money supply more closely than almost anyone. And what is M2 telling you right now about where global inflation, currency values are kind of headed next? Because, if inflation is baked in by money supply growth from 2 years ago, does the Fed even matter here, or are they just steering based on a rear view mirror?
Yeah, well, okay, let's not talk global because inflation is a local phenomenon. It depends on what the local currency is doing and growing at, and so if you look at that, if you look around the world, by the way, and this is one reason the quantity theory of money, which Matt Sukirky and I reintroduce and modernize in a way, in making money work. Why that's so important is that there's no substantial inflation in history that's ever occurred without a substantial increase in the money supply preceding the inflation. And when I'm talking about a significant inflation, by the way, Jeremy, I define a significant inflation as an inflation over 4% that lasts for more than 2 years. That's a significant inflation. And there's never been one that hasn't been preceded by large increases in the money supply. Now, let's talk about the U.S. for just a little bit. The U.S., the money supply since early in 2022 is actually the stock is of M2, measured by M2, that measure broad money. Actually, until a few months ago, it had been in a contraction. The stock was lower a few months ago than it was two and a half years ago. And that kind of contraction's only happened 4 times in the United States since the Fed was founded in 1913. And all 4 of those contractions were followed by recessions. And of course, one of the contractions was 1929 to 1933, and we had the Great Depression. Of course, that was a huge contraction of about 37% in the money supply, and a massive contraction. So where are we now? Well, now the stock is a little higher than it was 2.5 years ago, but the money growth measured by M2 it's only growing at 4.5% a year, and Hanke's golden growth rate, a rate consistent with hitting an inflation target of 2%, which is the Fed's inflation target, is 6.3%. So it's still pretty anemic. And all of this means that I think the economy is not only slowing, but we'll go into a recession. And that's baked in the cake. You said, well, does this depend on what the Fed's doing today? No, it doesn't.
Yeah.
It was baked in the cake a long time ago. And it has nothing to do with Trump or the Fed, with what they're doing today. Now, add to that problem of slow money growth the fact that you've got Trump engaged in imposing all these tariffs, which are a big negative. And in addition to that, Trump is engaging in trying to change all kinds of other things simultaneously, so much so that I think we have what's called regime uncertainty. The whole regime is changing, not just tariffs and foreign trade, but all kinds of domestic things too. So we've only had regime uncertainty one other time in the United States, and that was in the 1930s when Franklin Delano Roosevelt was president, and the New Dealers came in. Now they were left in their orientation. Trump is supposedly right. I would say both were in the same camp. They're big interventionists. They want to run the economy. The New Dealers wanted to run the economy. Trump wants to run the economy. I mean, Trump's the United States of America is a business, and he's running the thing like a CEO. And that's not the way. A sovereign is not a business. It runs it. It runs in a different way. So at any rate, they're back to the regime uncertainty. What happened with New Dealers from 1929 to the start of World War II, investment just stopped in the United States, and it stopped because investors want some idea of what are the rules of the road going to be. When I investment, what's the free cash flow going to be coming out of the thing? What's the EBITDA going to be coming out of the thing? Well, now they don't know, so the investments slowed down. If you look at the 10 years of Trudeau and the Liberal Party, the investment is completely tanked in Canada. Canada is really in trouble.
Well, I was going to ask you about that because, I mean, it sounds like we're staring down delayed inflation that was brewing all along here. I mean, Steve, how much of what we're seeing now, from sanctions to tariffs to the Fed's mixed messaging, is freezing that private sector risk-taking?
A lot. And I think it'll get worse. Canada has been on that road for ever since Trudeau. Mm-hmm. So it's kind of slowly ground in and is in place. Trump is a little bit more of a shock coming into the system, so people haven't had time to adjust, shall we say. And in Canada, they can see where the rubber meets the road and what lies ahead with more clarity, shall we say. By the way, this gets into the tariffs and how they backfire. So all the producers of booze in the United States, the booze sales to Canada have dropped by over 60% since Trump got into the tariff war. Because what? Well, it's the Canadians' propensity or desire to buy America. I mean, the tourism from Canada stopped. This has nothing directly to do with tariffs on exports from Canada. The attitude, you go into war with a country, an ally, put tariffs on them. Tariffs are nothing more than a weapon of war. And what happens? You get again, like sanctions, you get this rally around the flag thing. So the Canadians are rallying around the flag and saying, I'm not gonna be drinking American booze anymore. And I'm not going to go to America for my vacation. That's why tariffs are such a loser's game.
From your standpoint, I mean, let's talk about tariffs as a fiscal kind of lever. I mean, Treasury officials claim that tariff revenues now bringing in billions year to date and supposed to kind of be increasing here can offset deficits without raising income taxes. But from your standpoint, does turning trade policy into a fiscal lever pose a risk to, long-term economic trust?
Well, the way they've advertised the thing is nonsense because they advertise as if foreigners pay the tariffs.
Yeah.
Foreigners don't pay the tariffs. Americans pay for the tariffs. The guy who imports, if I'm buying something from you, you're sending me from Vancouver, I'm going to be the one paying the tariff, which is a tax. It's a tax on Americans. It's a sales tax, and it's going to be one of the biggest tax increases in U.S. history. Taxes is an old Reagan supply side, and anyone who knows anything about economics 101, taxes are always bad because they slow things down. By definition, they slow things down. let's talk about the tariff and the sales tax. So what happens? You sell me something. We agree on a price, terms of the sale, and everything. And I'm an American. I'm buying this stuff from you, and you're selling it at that price and on those terms because you benefit, and I'm buying it because I benefit. So they're what economists call gains from trade. Now, what happens with a tariff? You put a sales tax intervening and sucking some of those gains from trade out of the transaction. And of course, at the margin, what happens for marginal trades where the gains from trade aren't very great, they'll stop. So trade slows down. And you and I who've engaged in a voluntary transaction basically get taken to the cleaners by the government.
If the revenue is funding, tax relief or strategic spending, could there be a short-term case, even if the long-term economics are bad?
No.
Yeah.
It's a terrible tax. A tariff is a terrible tax. It's a Dumbo tax.
You brought us to that money supply conversation. And one of the things I kind of forgot to ask you, and I found interesting, I was reading some of your thesis this morning, and you pointed to post-2008 rules like the supplemental liquidity requirement as a brake on lending, with U.S. loan growth I think it's stuck around 4%, 4.5% annually. If those rules were lifted, how much would that change the inflation and growth outlook in the U.S.?
Well, not much. Number one, this gets back to there are really 3 points in this book, Making Money Work. Mm-hmm. One is to get the quantity theory of money and focus on money back in the picture. The quantity theory of money being a fundamental macroeconomic model, not these neo-Keynesian models that everybody has been using and been brought up on for the last 30 years. The neo-Keynesian models, they don't include money. They're not in the models. So all the people at the Fed, that one reason they don't talk about money is the macro models they have don't include money. So even at a theoretical level, money's out. We want money in, and we want commercial banks. The second point, we want commercial banks back at the center financial system because commercial banks produce most of the money. Most money, broadly measured, is produced privately by commercial banks. Mm-hmm. About 80% of the stock of M2 in the United States is produced by commercial banks, not by the Fed. So the regulations of banks, you mentioned the supplemental liquidity ratio, which was put on after the great financial crisis in 2008. And that kind of constrains the banks because they have to have reserves covering so-called safe assets like government bonds that are the same level as more risky assets. So it constrains and puts restrictions on the capacity of banks to loan. Mm-hmm. So they're talking about taking that off, by the way, which I think would be great. But bank regulations are part of monetary policy. That's our second point. The third point is the thing I was talking about earlier with regard to neutrality. You want to implement your monetary policy so that it's neutral and doesn't distort and discriminate against different sectors of the economy or different individuals. So back to increasing the capacity of the banks to make loans, that's not going to increase inflation unless inflation is not, the money supply is growing at 4.5%. I think 6.3%, around 6% is a rate consistent with hitting a 2% inflation target. So right now, as you said, the commercial banks' loan growth is actually at 4.5%. So it's no surprise the money supply is growing at 4.5% because the commercial banks are the main providers or suppliers of money, basically.
You pointed out that, in that fiat system, most money isn't printed by the central banks. It's those commercial banks through lending. If that's the case, is it fair to say then that the Fed's control over inflation is overstated because it's the pace of, private credit creation that really drives money supply growth.
Well, they do have there are two aspects to the controlling the growth in the money supply. One are these regulations on banks. Mm-hmm. They don't change very often, but they do affect the potential for the growth rate in the money supply. And the other is much shorter term things that the Fed can do, like, for example, quantitative tightening or quantitative easing, expanding the balance sheet in quantitative easing or contracting it in quantitative tightening. Right now, there's still quantitative tightening. And I think they should drop it because I think the money supply is anemic. Its growth rate's anemic. So one way to do a less anemic, looser policy would be to stop quantitative tightening. And the other thing would be to change this bank regulation and get rid of the supplemental liquidity ratio. Mm-hmm. Those would be the two things that I would be doing. And all this focus you see on the interest rate, the Fed funds rate. Monetary policy is not about interest rates. It's about changes in the money supply. So everybody's focus is just wrong. Everybody's looking at the interest. Even take Trump and Chairman Powell. They're quibbling over what? The rate at which the federal funds rate should be set. They're both wrong. They should be looking at what's going on to the money supply.
Yeah. Not to mention also, the data reliability. It feels like here, Steve, I mean, this year, over 500,000 jobs have disappeared from official counts through BLS revisions. I mean, we saw the head of the BLS get fired. We've been talking about this data changing on our show for years here. But at what point does this stop being a statistical quirk and start being economic misinformation? Do you believe bad data, intentionally or not, is kind of being used to maintain public confidence?
No, yesterday there's an article in the Financial Times where I was quoted, and everybody's just got this whole thing wrong with the BLS. Number one, the quality of the data has been going down for a long time, and the reason is very simple. They send out these surveys, and the rate of response has gone way down. So they don't get information from the field. And at the BLS, the bureaucrats have to model and forecast and make guesstimates. And then as real data come in over time, they have to revise because they're off. And why were they off in the first place? They were off because the surveys are not very complete, and there are a lot of errors in the surveys, so that they have to make estimates. So the first estimates are what they are, the data are what they are. There's a template for doing this. You can't manipulate the data. This idea that this is just rubbish. There's a template. It's very detailed. There are bureaucrats that run the thing, and that's the end of the story. The data are the data. And the problem is the quality of the data have been going down. Mm-hmm. But I think that manipulate is ridiculous. And the second thing that I was commenting on is that it's pretty much irrelevant who the commissioner of the BLS, the Bureau of Labor Statistics, happens to be, because the template and the bureaucrats run the thing. Mm-hmm. Who's at the top doesn't really make that much difference.
Steve, before we let you go, and I wish I could interview you for hours here. There's so much to talk to. We've been pivoting to different conversations, but looking ahead at 2025, I mean, we got this regime uncertainty at home, this possible recession on your radar, tariffs rising, of course, and the slowest money supply growth in decades. If you put that all together, what's the real playbook for investors and policymakers next year? Is 2025 the year of dollars dominance starting to visibly erode, or is this just the U.S. market still having one last leg higher?
Well, I think that if you look at the market, I think the dollar will continue to weaken because I think it's overvalued. Mm-hmm. I think the fair value of the dollar euro exchange rate's 120 to 140. It's trading at 117, and it's been getting a little bit weaker not much, but a little bit weaker. And I think that the weakness will continue, particularly as we go into recession and as the Fed is eventually forced to lower the Fed funds rate. So that's the dollar side of the thing. But you looking at the money supply and looking at things that Kitco people are interested in. Mm-hmm. If you look at China in the commodity space, China is the elephant in the room. It's the beginning and end. So if you don't understand China, you got a big problem if you're in the commodity space. And China right now has a Hanke golden growth rate of 10%. That's consistent with the growth of inflation rate of increase at 2%. But M2 is only growing at 8.3%. So no wonder they're in a deflation. The inflation rate, since February of 2023 has been below 1% all of that period of time. And it's actually dipped into negative territory on several months. Mm-hmm. And now it's plus 0.1%. So what's going on? You've got what they call in economics a balance sheet recession. You have everyone deleveraging. They had too much leverage. Then the real estate bubble popped, and now they're scrambling trying to deleverage. Now, when you do that, you don't want to take on more debt from a commercial bank. So the demand for credit is weak in China, and that's why the money supply isn't growing. Back to the fact that commercial banks create most of the broad money. The rate of growth of bank money is 8.1% in China right now. The central bank is trying to offset that by increasing rapidly the rate of growth in base money. That's increasing at 12%, but the bottom line is the overall growth rate's 8.3, and to hit the inflation target of 2, it should be about 10%. So what's that mean? Base metals, aluminum. If you look from now until June of 26, the forecast, the consensus, essentially no change in the price of aluminum, essentially no change in copper, no change in lead, a slight increase in nickel, a slight decrease in tin, and essentially no change in zinc. So you have all the base metals are just flatlining. And the reason they're flatlining in terms of the forecast out to June of 26. Now, the reason for that is the money supply and the fact that China is in a deflation. And as I say, China is the elephant in the room. And commodities, that's it.
Yeah, I was going to say, if their deflation deepens, I mean, how much downside do you see for base metals before supply discipline kicks in?
Well, as I just gave you out to June, I didn't go any further than that. But it looks from now until June, mm-hmm. the consensus on all the base metals that I mentioned, it looks like they're flatlining. Not much movement one way or another. And that's because China is basically flatlining. Their target real growth is 5%, and the target for inflation is 2% in China. That means that the nominal GDP target is 7%. And as I just told you, inflation is about 0 now. And there's no way real growth is going to be 7. Right? So basically they're not going to meet the target.
Yeah. So I mean they're essentially flatlining right now. Given that they consume almost half of the world's industrial metals, that's not a very small signal. If Beijing can't reflate and domestic demand stays soft, what does that do to global commodity pricing power? I mean, you just said we're kind of looking at a ceiling. Is that for copper, nickel, and aluminum for next year too?
Well, some of these commodities it depends on where they are in the cycle. The base thing I've given you, but other things, for example, like like lithium and vanadium have been so bombed out and a maximum overshoot on the downside that you have a lot of capacity that's being shut in. And as a result, the demand for lithium and vanadium, it goes up. And so if you're shutting down supply and demand is trending up, you're going to turn things around, and you could have some big spikes. So the idea of the economy is flatlining in China, that's fine. That influences base metals tremendously, and it looks like they're flatlining along with China. But all these other markets, you have to realize what's happened. I mean, what's happened, you had tremendous downward spikes in things like lithium and vanadium. I mean, losing 70-80% of their value. And as a result of that, you have a lot of supply that's going to the wall. And as a result of that, we know what's going to happen next. The price is going to go up.
Yeah, well said. Okay, well, we got to quite a bit of it. I didn't get to everything that I wanted to ask you here. Of course, our time went a little bit too fast. On this topic of hard assets, I mean, we were talking a little bit about gold, and I am curious what your thoughts are. I mean, we've seen this wave of central banks from Germany to Poland to Hungary pulling gold back from New York and London vaults in recent years. The official line is logistics and diversification, but many read it as a signal of the waning trust in custodian abroad. If you were advising a central bank today, would you tell them to bring their gold home?
The problem is that the respect for international law and property rights and so it's eroding tremendously, so the advice would be yes, and the advice would be to buy more gold. Gold's going up.
End of 2025, you think that's still going to be above 3,300? What are your thoughts on price?
If you're trading, people always ask, well, they say, Hanke, what's your forecast, for some specific price for a specific day? If you're a trader, you just have to know the direction. I just want to be long. Yeah. It's going up. Where the end of the road will be, we'll decide that when we get closer to the end, and then is when the decision or end point or end price and that kind of thing comes into the picture. But right now, I'm sleeping tightly and long. But I've been that way for quite some time.
Long it is. Well, it's done well in a year that it's made many all-time highs. Steve Hanke, of course, professor of applied economics at Johns Hopkins University, distinguished senior scholar at the Mises Institute, and author of Making Money Work, a brand new book just out this May. Always a pleasure. Appreciate your time, Steve.
Great to be with you. Look forward to doing it again.
And that's it for this edition of Kitco News. I'm Jeremy Szafron. If you found value in today's conversation, hit like, subscribe, and turn on notifications so you don't miss our next interview. And tell us in the comments, what's the single biggest long-term risk that you see to the global monetary system? We read them all. I'll see you next time.